with different risk. So for me, I am able, because of this asset type, I'm able to measure the risk in advance and present that risk for the more risky investor and the less risky investor. And that's kind of, I never thought about it like this when I started with it. And that's fascinating.
That's interesting, because you have a different perspective on it, and you're giving those different perspectives. So that's really interesting. Awesome. Well, we're coming close to the hour here. I see our very special guest speaker, the last minute guest speaker, Jerome, has joined us. So I greatly appreciate you coming on and joining us tonight and sharing some of your wisdom. And as people kind of filter in, I guess as the hour is coming upon us, people start jumping in slowly. I'm just multitasking over here, trying to get running, which we got now. Okay, we're good to go. So without further ado, I think as the hour is about to tick, why don't everyone just put in the chat over there where you all coming in from today? Because I love the fact that we get people from all over different places. I recognize a lot of you. Thanks for coming back. I definitely, it's awesome to see the same people every week. We got a great presentation tonight. Jerome is setting the stage for a great presentation. I'm really excited about it. Making you the co-host so you can share your screen, which I'm sure you'll do. Oh, we got a lot of Texas in the house tonight. New Orleans, right? Awesome. Boston, KK, Fort Wayne. Jerome is outside the matrix, which basically means he's like everywhere, like me. San Diego, Illinois, Florida, North Carolina, New Jersey. One of the things I love about this is literally people from everywhere. Vivek from the Bay Area, Beit Shemesh, Israel, Yaakov, Kenneth. Oh yeah, in the house. Dallas, Texas, New York, awesome. So I'm really excited for everyone to be joining us here. As I said, we got people trickling in from all over. I'll just make a quick introduction here, and then we'll just get right into it, because I think everyone's excited. Everyone's here for a reason. So let's just get the show on the road. As I said, you guys probably know me, Yonah Weiss. If you found this somehow, you found it on LinkedIn. Maybe Jerome was promoting it a lot, so that's probably how you heard about it. And yeah, we're really excited about this presentation because it's a little bit different than most, as I'm sure you'll come to see, and I'm excited about it. A little bit about me for those of you joining. Yonah Weiss, you may have found me on LinkedIn. A lot of you guys are on my LinkedIn challenge. We're doing a 10-day challenge right now, so you guys are awesome. I'm seeing tremendous amount of people like putting in crazy amounts of time and energy into utilizing the benefits of posting on LinkedIn regularly, which to me, a lot of people don't even know what that is or the benefits of that, but I think a lot of the people that are doing that get that. So I just want to give a quick shout out to all you guys who are on this call doing that. Good for you. Keep it up. You'll see tremendous fruit from those labors. Again, my name is Yonah Weiss. I work during the day. Besides for spending time on LinkedIn, I work for the biggest national cost segregation company. So I spend my time just helping people save income tax through this awesome tax strategy called cost segregation. If you want to hit me up on that later on, you know where to find me. I'm a host of the Weiss Advice podcast. If you guys didn't check that out already, I would be very, very grateful. Just using this opportunity here, since we've got all you here, and to maybe check that out. So I'm going to put that in the chat box over there. I'd love you guys to check that out. Leave a review, a rating if you like it. If you don't. But you don't have to leave a bad review. Just leave a good review if you like. And Jerome, check out Jerome's episode was, I think, episode number 7 or 8 or something, right at the beginning of the podcast. So you can check out some more about what he's going on. So without further ado, I'm going to introduce Jerome. He doesn't need an introduction, but he's very humble. So he thinks he really doesn't have a lot to offer, but we'll see here. He's the host of 2 or actually 3 podcasts, Dream Catchers, the Multifamily Missteps, and I forgot the name of the third one, but it's something about PTSD, right? Something like that for military people. He is an investor, right? Has invested in a lot of real estate, and he's really favoring joint ventures over syndication. So we're going to find out why. And Jerome, I'd love for you to give a little bit of more introduction background. And without further ado, thank you all for joining. Don't forget that we have the Zoom breakout rooms at the end. So after the presentation is over, we're all going to split up into little groups of 2, 3, 4, maybe 5. And to get to room, just network a little more personally. So that's a lot of fun. If you're on the Facebook Live, remember you click that link so you can get on the Zoom to check this out. Jerome, the stage is yours.
Oh boy, starting trouble now. Yonah, super grateful to get the opportunity to share with the group. Can't believe there's 53 people on, but I guess you gotta take you and me out because we had to be here, right? For everybody that's here, I'd love to know where you are. So if you haven't bought anything yet, type 1. If you have bought something less than 10, type 2. If you are over 10 but less than 50, type 3. And if you're over 50, type 4. I appreciate all this engagement. Paul, I want to be like you when I grow up. Andy's on here? Andy's everywhere. I don't know how he does that. This is awesome. So a lot of different levels, which I think is super awesome. I'm gonna try to talk to everybody tonight. If you don't like something I say, it's great. Let's have a debate. That's what this is about. I'm quite contrarian when it comes to a lot of this stuff. KK, I didn't know you were on here, man. Hey, I hope you guys, well, I'll talk about KK later because he had an awesome presentation. He made me want to quit. Whoa, Yonah, we're almost at 60. All right, so let me share my screen and we'll get started. Don't go too far because I'm gonna ask guys for input along the way. All right, this is my mom and dad. Like, they have no idea what I do, but we were driving around one Saturday morning. I was like, let me show you guys something. And we pulled up at the complex and my dad kind of scratched his head. He's like, why does it say Myers? I said, because we own this thing. And so this is our first deal that we bought in Greensboro, North Carolina. It's a 20-unit building. And I was like, you guys got to go take a picture. And I also took one with my kids there too. But this was important for me because when I dropped out of corporate America, my mom freaked. She was like, what are you doing? Like, you got good grades, you got into a good school, you got a good job. Why would you leave corporate America to do this weird thing that other people are doing? And, you know, you might not ever have health insurance and some of the other stuff that she laid out for me. And so it was important for me to just kind of show them some of the stuff we were doing. And so, you know, we bought this, it was like 20 units, $840,000 purchase price in Greensboro, North Carolina. So for tonight, I've got like 25 slides. I'm not going into presentation mode because I want to be able to see the chat while we go through this thing. And we are going to go through why I started speaking because I think it's super important because I think there's some people out there with some really inspiring stories and I don't really feel like they share all that much. So I'm going to tell you guys a little bit about my background, why I started speaking, dive into just some definitions, the differences between joint ventures and syndications, what I consider people having roadblocks to get into multifamily, because I see there's a bunch of ones in here. And then I'm gonna use myself as a case study, show you guys how the joint venture worked for me to get into the game, lay out some of my biggest mistakes, just because I feel like that's the only way to be true to this audience, offer up some free resources, and then dive into Q&A, and I'm trying to land this plane with like 2 minutes left so that Yonah can say nice things about me at the end, and then we'll go to the breakout sessions. Sound good? Type a 5 if it sounds good. Anybody? Somebody, please? Yes, perfect. All right, disclaimer, I don't know what I'm talking about. So don't rely on anything that I say to make any investment decision. I'm not a CPA, I'm not an attorney. But before we get into all that great stuff, I want to tell you my story. So back in before May of 2019, which is like, what, 12, 15 months ago, you couldn't find any pictures of me except one where I was on a news site because we lost a football game and they took a picture of me on a knee, basically crying because we got blew out that game. And I was like, man, I did a pretty good job of staying off the radar. And I thought that was amazing. And then what I realized is like, I was a total ghost. I was having some success. And by being a ghost, I was part of the problem, because when you look at the people who have platforms and who speak, there isn't a whole lot of diversity. There's been more people that's come on the scene more recently. But when I was getting started back in 16, 17, like, there wasn't much diversity at all. And then even when you go around and you look at the conferences, like, and I encourage you guys to be cognizant of this when you're making your buying decisions. When you go look at the big conferences, if there isn't people that look like you, and I actually had to go through this year speaking, you might want to ask the host, hey, is there anybody that looks like me that can speak, so that I can actually support the event? And that will help get more people with more diverse stories sharing them. In addition to that, my challenge to you, if you're here tonight and you're having any success, you know, those 2s, 3s, and 4s, I really want you to share your story. I've got 2 podcasts, more than willing to have you on. There's a bunch of other people out there, and hiding in the shadows doesn't inspire anybody else to go do the thing. And I think that where I really landed was, we're being super selfish when we don't share what's happening. It's not about bragging. It's not about boasting. It's about saying, hey, I did it, you can do it too. And that's what this conversation for me is about tonight. And so this was pictures from one speaker lineup, and I struggled with it because it was like, wait, there's nobody that looks like me here. And so let me talk to you about what happened. So I was in my own little world. Before I left corporate America, I had the good fortune of building a $20 million division for a Fortune 550 company. I was employee number 2. I was responsible for P&L, and we were taking overhead power lines, putting one underground. While I was doing that, I was lending private money to fix and flippers, and I was learning about rehabs by putting my money in their deals. Through that, my reward from going from $0 when I showed up to 20 million in revenue and about $6 million in profit that first year was laying about half of the 175 people that we hired off. And that was the first time I was the axe man. I felt really terrible about it. In fact, I didn't really eat or sleep between Christmas Eve and New Year's that year, because I didn't really know what to do with the situation. And where I landed was, hey, Jerome, somebody else can make these decisions for you, but you probably want to do it because you've got to run the team next year. And so I said, I'm gonna get through this, I'll do it. And then after we put Humpty Dumpty back together again, I said, I'm never gonna do this again. Fast forward to November the next year, I had to do the same thing. And I said, I'm dropping out. And so I started self-educating. I realized in my sophomore year in college that I wanted to be a multifamily investor. Me and my buddy Jerome was sitting on the stoop. We did the math when we found out the guy that owned the property was making $700,000 a year top line revenue. We never seen him and never talked to him, but we just didn't know how to get to that place. And so I started doing this self-education after working in corporate America for a number of years. And then I found my first deal, and I went to the banks and I was like, hey, I got this $1.3 million property. Don't you guys want to fund me? And they kind of looked at me and scratched their head and then turned to the side and was like, why would we do that? I said, well, I just built a $20 million business and we were profitable 30%. Yeah, okay. I'm a professional engineer. So what? I got an MBA? Yeah, that's not experience. And they said, well, what's experience? They said, have you executed the business plan that you want to do on a building of similar size? I said, no, of course not. This is my first one. They said, well, go get a partner. I said, but I don't know anybody. And where that left me was I had to go fix and flip houses because I couldn't get money to do my first apartment deal. Fortunately, I was sitting on the stoop of one of those buildings and one of my fix and flips, and the guy pulled up. He said, let me check out your finishes. I was like, whoa, okay. And he's like, we're doing one down the street. We're going to try to make sure that we're comparable when we come to market. I said, oh man, that's pretty cool. Then we kept talking. He's like, hey, do you know anything about that building? I was like, yeah, I tried to buy that 4 or 5 months ago by myself. He said, well, I'm getting ready to make an offer. I said, what? You're the guy I've been looking for. You're the experienced guy that I needed. And he said, what are you going to bring to the deal? I said, I don't know. Like, we'll figure it out, but don't leave me out. I want to do the deal. And he went and made the offer without me because I didn't know what my value add was. Fast forward, he went and it got rejected. He went and talked to one of the guys that I was investing with private money. And he said, hey, I want you to be the GC on my deal. He said, oh, that's the one Jerome was talking about. I'm only doing it if he does it. I was like, yes, he got me back in the deal. So I was fortunate enough to get in that first deal, and we bought it from one of the bigger brokerage companies, and they always do a press release when somebody closes. And I was asset manager, so my name was in the paper. And guess who started calling me? The banks. So now I had experience. I'd done a deal, even though we hadn't actually executed the business plan, but because we had closed on a deal, it proved that I could close. And so they were interested in lending to me. And so I took that. That was the only contract that I've closed on where I didn't write the contract. And we came down to Greensboro and we started buying properties here in Greensboro. And so today, you know, we've raised over $1 million. We've repositioned more properties. This is an older slide. And we're working on our first development deal, which is 120 units of workforce housing in an opportunity zone. And I think we're going to break ground next spring. Again, I just want to drive this point home, guys. Like, diversity matters, and not just like in people's appearances, but in your approaches to buying multifamily. And that is why I really beat this drum of like, there's not just one way, there's not just one thing. I will tell you that syndication is all the rage. I think there are a lot of people who are creating wealth in syndication. And I think there's a whole lot of smoke and mirrors in syndication used as marketing in order to get people to put their money in deals and not actually allow them to get to a place where they're actually a deal lead or an operator if that's what they truly want to be. And so I just want to show you guys another option. And I'll take that point a step further. For a lot of people, the syndication approach isn't working. Like, I listen to a lot of people and they end up coming to me after they've spent $25,000 to $50,000 and they say, hey, Jerome, like, I'm not getting any traction with my mentorship program. I thought I was going to buy a deal. I thought I was going to take one of these big ones down and I just haven't had any success. How can you help? And I was like, well, get some tuna in the boat. And so with that, I want to roll into uncomfortable truth number one. And that is, like, most people who do these high ticket programs don't ever become a deal lead. And I can say that with confidence because of the number of people that I hear complain about their high ticket experience. And whether they ever do anything with me or ever do something on their own, the fact of the matter is the dream that they were sold, hey, you're going to go take down a $10 million deal or you're going to take down a 100-unit deal, isn't what actually happens when they get through their first year, their second year. And I've seen very few people do it. There are some people that I know. One of my favorites is the guys at Four Oaks, and particularly Brian Briscoe, because that's who I have the deepest relationship with. They have actually crushed it through their experience. And so there are some people that are, but I will tell you that the vast majority of people who do it don't. And some of it is the program's fault. A lot of it is the people who are in the program's fault. And there's a whole lot of discussion that can go on through that. Uncomfortable truth number two. You have a 95% of doing this alone in a company that you operate. Like, when I pull these statistics and it's just like, in the end, like, you're running a business. And so if you're an operator and you're self-employed, like, the vast majority of those folks don't have anybody working with them. And just keep that in mind, because everybody says, oh, it's a team sport. But then when they try to find partners, you're like, oh, but nobody either wants to partner with me or I don't know what I bring to the deal. So why would anybody partner with me? Back to my mistake on the deal that I was trying to get into on the first one. And the last one, a lot of people feel like, hey, if I write this check, it's going to fix everything. And the transaction doesn't actually mean anything. What you do on the backside of the transaction is what makes everything happen. And so be super resourceful, make sure that you're being social in the places that you can be social. And those things are what's going to make the biggest difference. Let's see. Yonah, you're going to have to help me on the chat. There's a lot going on there and I can't keep up. All right. So let's go see this thing from the Purple Book. And I think he wrote another book about it, right? And so I have tweaked it a little bit because I really think it drives the point home. So everybody wants to be an investor. Everybody wants to be in the I quadrant. And for a lot of people, they confuse being an operator with being an investor. And so for me, I'm starting I because that's what's so sexy, right? Because your money works for you. Limited partners are investors. They put their money in and then they're out. If you're still in the wealth building phase, it's probably not best for you to be an investor because you can get a bigger return by investing in your own deal, by being a joint venture partner or a business owner. It's always interesting when I have people who are running their own business and they say, hey, I want to put money in your deal. I was like, well, how much do you have? Oh, I got 10 grand. Well, put that back in your business and then turn it into 100, then come back and do something. But we're trying to be diversified and we're trying to come up with these portfolios instead of betting on ourselves. And so what I really encourage people to do is, like, if you're in the wealth building phase, you want to be a business owner so that you can use your money to be fuel on your fire. Moving back down the continuum, being self-employed, those are the third-party property management companies that the vast majority of operators use. There's some small groups that are vertically integrated and they're able to do everything in-house. But for me and the majority of people I know, there's third-party property management. And for most of those companies, it's going to be somebody who's self-employed. So it's like a husband and wife, or a husband, and then they've got their company. And within that company, they'll have a community manager. And so usually what happens is the employee and the business owner interface, and then the self-employee or the property manager is kind of overseeing what's happening for the community manager. All right, so now let's get into these definitions. What is a syndication? I like to describe it as an airplane, particularly a jumbo jet, right? So you've got the lady at the ticket counter. Hopefully everybody's flown or knows what the process of flying is. So I'll walk you guys through. You get to the ticket counter, you buy your ticket, you go through security, you get to the gate, you give the lady your ticket, she scans it, she's getting paid to be there. You go down the walkway, you get on the plane, you're greeted by a steward or stewardess, you wave at the pilot and the co-pilot, and you go sit in your seat. That's what a LP does in a syndication, right? And that person is just along for the ride. They don't have a voice. They don't do anything to make the thing get better or go better or be better. They're just there, and they paid to be on. The other people are getting paid to get you safely from point A to point B. Those folks that are getting paid are in the general partnership. What does that mean, Jerome? Hey, if you put $1 into a syndication, you're getting something less than $1 in equity. I've seen splits as high as 90-10. I've seen some people who take them down 65-35. And that, in this instance, the 35 is going to be what the sponsor of the deal or the general partnership is taking away from the deal. So you're getting 65 cents of equity for every dollar that you put in. There's nothing wrong with that. Those folks should absolutely be compensated for the work that they're doing. But with that said, just know that if you're on the limited partner side, you're not maximizing where your dollars can go because you're not participating in the work. A joint venture, I like to classify it as a fighter jet. And from my perspective, because I wanted to be a fighter jet pilot when I was a kid, this is the coup de grace, right? Everybody's got an active role. Everybody's getting experience. Everybody's got a voice. And there's a bunch of different roles and parts and pieces that people can play in these things. And the deal is really only limited by the capacity of the partners in the deal. The one thing I will say is, like, there really isn't a difference between a joint venture and a syndication outside of the limited partners, right? The general partnership is a joint venture. And I don't think anybody has this conversation because it's not as sexy. And so what I really see is, hey, if you've got capacity and you have people in your network with capacity, the fewer people that are in the deal means you get to own more of the deal. And for me, that is what it's truly about, is the wealth building and through the equity. Let's do it side by side. I'm only going to talk about the pros in joint ventures, and I'm only going to talk about the cons in syndication, but take a screenshot so that you have this and you can beat me up on it on LinkedIn or something later. So the pros of joint ventures, it's easy to get that experience box checked, right? If everybody has an active role, why wouldn't you want to sign the loan? Because you know if you want to go do your own deal and you want bank financing, they're going to want to know that you own something already. Why wouldn't you want voting rights? I think everybody wants voting rights. If you're not in the general partnership in a syndication, more often than not, you don't have the ability to vote. You're in the deal. Once your money's in, it's in. You send that wire, it's over for you. There's more deals available. And this one is really important for me. I think there are, 6, 7 groups around the country that are all chasing 100-unit deals with an upside. And I wish there was a broker on here so I could pick with them, with upside and, below market rents and operational inefficiencies. Guys, like, in a growing market, like, everybody's looking for the same thing. What about all the deals that are less than 100 units that aren't as desirable, air quotes? Like, you can make monies with those. And I'll jump down to the last pro on a percent basis. Like, if you are able to improve the operational efficiencies in the business, I think you can absolutely get a higher percent basis increase, even though the dollar amount might not be as big, by doing a deal that's a little bit smaller. I think the pro of the deal leads experience being a little weaker, or them being less experienced, is important if you want to have a voice. If somebody's been doing this 25, 30, 40, 50 deals and they have all the answers, when you come in, they might not be as open to hearing your ideas or suggestions or recommendations. And so, having somebody who's open and interested in partnering and getting the input from other people is, like, for me, is super important, because I like being heard. And the other thing with joint ventures is I've seen a lot of people that do syndications just say, hey, we want to get max exposure, so we're only going to deal with accredited investors. We're going to do a C exemption so that we can advertise. And what that does is it leaves the sophisticated investors out. And so a lot of joint ventures get done with sophisticated investors. And if you need to know the details on that, we can dive into the difference between sophisticated and accredited. Cons of syndication. Again, the lean towards accredited investor. I can't emphasize this enough. No real voice or vote as a limited partner. If you're an LP, there are some people who say, hey, just passively invest in a deal and you'll get some experience. But from my perspective, all you're going to get is some reports, right? Like, when you are a passive, you're a passive. If you want to be an active operator, you got to get in the active operator seat so that experience really does count. If you don't sign a loan, the banks do not count that as experience. I can't emphasize that enough. And I think there's fewer deals available. Yeah, I did see that, Alex, where they expanded the definition of what an accredited investor is. I don't know what the details are, but I did see that. So let's use me as a case study. And what I will say, this is the price of it. Because I think this is the order that you actually overcome these challenges if you want to get into multifamily investing. For all those folks who hit the ones and even the twos, if you're looking to scale and go bigger, I think this is big for you. The knowledge is foundational. And I'm not going to say that what I did was the right way to do it, because I'm actually going to pick on myself in a second. But podcasts, books, and YouTube is not the answer. I can promise that. Deal flow. Once you have knowledge, you can apply that against your leads. Your leads that actually pass your vetting criteria become deals. And those deals are what you take. And this is your golden ticket. So one of the things I promised on this talk is I would tell you what your golden ticket is into a deal. Finding a deal is your golden ticket into getting a deal done. You take that deal and you go partner with an experienced operator, right? That's what I had to do. If you guys remember the story, I opened up. And that experience is going to draw capital. And that in and of itself is how I think you're able to get into it. So if you don't have access to capital, that's not a reason to not get started in multifamily. A lot of people just want to go to the top of the pyramid and say, oh, well, I don't have any money, so I'm gonna spend all my time raising money. But you're not even credible because you don't know what you're talking about, right? So get the knowledge, apply that against the leads so you know what deals look like. And then you're going to want to have an experienced operator on your team so that you can get the big money, which is usually the bank money. And then you can get the risk money or the equity to come to the deal behind that. And I really think this is the formula for people getting a deal done, especially that first one. So how did I get started? I started self-educating, right? I had this huge knowledge gap. I was listening to 40 hours of content a week, every week, and I still probably listen to 25 or 30. Podcasts, books, YouTube. I would go to the RIA, but my RIA never talked about multifamily. And so when I brought that in, we started having more and more conversations about it, but it wasn't popular at all in the area that I was in. But most days I ended up feeling really confused Other times it was overwhelmed, overconfident. I really remember those days, and then frustrated. Well, why do you feel those? Well, if I'm listening to the guy from the north, and I'm listening to the guy from the west, and then the guy from the Midwest, and then the one from the southeast, and they're all telling me about how things are supposed to go and how things are supposed to be and how they've got this proprietary process, or you're supposed to do this with property management, and none of it actually fits with the ball that I'm playing with. It gets super frustrating. And so I didn't know what to do, and I just knew that I didn't actually have something that was concrete that would allow me to move to the next level. And so there were times where I just put my head down and said, I'll try again tomorrow. All right, deal flow. This for me is, again, that golden ticket, right? And so the three things that we use most is LoopNet. I know people say that's where deals go to die. I don't agree with that at all. We've been able to buy at least 2 properties from there, and we were able to buy them at discount, so it made sense. We've bought deals through direct mail. When you think about, especially the properties that are under 100, you can actually get to the owner. And I'll combine that with a lot of the owners are older. And so they're baby boomers, some are even traditionalist generation. And in that, they are ready to retire and they're looking for a way out. And so we're super happy to let them come in and divest of the asset, bring our capital infusion, raise rents, decrease expenses, all the stuff that you hear in all the great marketing material. And then networking is amazing for me, right? So if somebody comes through our program, or if somebody knows, hey, that deal's in Greensboro, we're dealing with it up here in Northern Virginia, who do we know that is in that market? Well, I'm in that market, and it usually ends up coming to me. It's very rare that a deal trades that I don't actually get the opportunity to see, which I think is super awesome, and why I like to invest in my own backyard. Um, the one thing about the smaller deals, I will say, is there's less full-time competition. And for me, this I see as a real competitive advantage. One, if there's an attorney or a dentist or a doctor in their chair side or their bench side or whatever they're doing in their full time, and the deal comes up, the agent gets to a listing agreement, or we're hitting the phones and calling people, we're able to get to that deal first. And for me, that gives us an opportunity to build a fence around it and then slow down. So we're really fast to get to the deal, get it under some form of contract or LOI, get it tied up. And then we really slow through our due diligence process to make sure that it's something that we want to close. Capital. Yeah. So I'll just tell you guys how I did it, right? I had some savings outside of my 401k. I had access to credit lines. I had a whole life policy with some cash value in it. And then we were doing a recourse loan. So the banks were looking for W-2s. I used my last W-2 in order to help qualify, in addition with my partners. In addition to that, I share this opportunity with friends and family. And I had some guys from college, high school, and people I met while I was out working who were interested in participating as partners. They were all interested in this idea of our investment making an impact. And so this is one of the things I'll talk about a little bit later, but it's not just about maximizing the profit that we can. And one thing that's important for me is, when I think of an accredited investor, I think about somebody who's already wealthy. I want to open the door for multifamily, mid-sized multifamily is what I'll call it, to people who aren't already wealthy, because I think this is a true vehicle to grow their wealth. All right. Experience. So I didn't even know about these things like what we're doing tonight, where, there's these meetups or groups in social media, conferences. I guess I knew that from a professional standpoint, but I didn't know that people would like fly to another city to meet with other people who are interested in the same thing, and they spend a weekend doing it. Like, that was kind of foreign to me. And so I really wish I would have done those things before I got into the game. Kudos to you guys for spending your evening or late afternoon with me, listening to me ramble about this stuff. But the more of this you can do, the more you can grow your network, the better off you'll be, because you'll know more people in the space, and who knows who's going to be able to make that connection for you. Experience. I just want to hammer this point home because I don't think people hear it. if you haven't signed a loan, you don't have experience. And that's a full sentence, right? So I tried to get a loan. Banks told me no. We talked about that. I also tried to talk to hard money people because I was like, oh yeah, well, that'll work, right? Because that's what we do for fix and flip. It's not a great way to buy stuff, which is, if you haven't done a deal, I don't encourage bridge debt, just so you guys know. But the hard money guys are like, yeah, there's not enough meat on the bone and you don't have any experience. It was like, what do you mean I don't have any experience? People kept telling me I wasn't qualified to do what I wanted to do, which was super frustrating because I spent a lot of money in school. I didn't have any private money lenders in my network. I didn't even know what a self-directed IRA was. And you want to understand those things because it opens up doors that you have no idea. There's a lot of people with retired money who want to be out of the stock market, but they don't know where to go. And so there's tons and tons and tons of opportunity there. And I guess the last thing from an experience standpoint is I didn't know anybody who owned multifamily. I know I said it before, but I just want to come back to that. Like, there are people, like, if you are a one and there are people on here that type 3 and 4, you want to know them in some way, shape, or form. So go connect with them on LinkedIn, start building your network, because I just baited them into telling you that they're in the game and now you have the opportunity to connect with them. It's amazing. But yeah, at the end of the day, guys, look, you need to expand your network of operators so that when you find that deal and you know that they invest in your area, you can get into a deal with them and get that experience. My most costly mistakes was being self-taught, right? And they're like, what do you mean? You could have spent 50 or 30 or 45 or whatever the number is, and that would have been really costly. It's only costly if you don't factor in how much your time is worth, right? And I'm not telling anybody to go spend that much money in a program. I think there's other ways to do it. But what I'm telling you is there is something to be said for having somebody curate the content for you so that when you get to the end of the road, you have a system in place that you can use as your baseline. I didn't have that. I was getting stuff from all over the country, from everybody who had a thought leadership platform. And the vast majority of them weren't even talking about joint ventures. They were talking about syndications and how to raise money and all this other stuff. I didn't need to know how to do that. I needed to know how to asset manage a 23 unit that we were doing everything from the roofs to the parking lot to removing walls and all this other stuff. And nobody was talking to me about that. And on top of that, everybody always made money. They always had their project on time, on schedule, and they never lost. There were no mistakes. There were no headaches. And that just was really frustrating for me because I had all of that stuff. When you're in these JVs, you get the opportunity to be involved in operational decisions. Some people don't want that. I get it. There's a whole lot of people who want that. And I don't want anybody to think that being a limited partner is getting you that experience in a syndication, because it isn't. And then I guess the other thing is usually these deals are smaller, so there's less risk if something goes terribly wrong. What does that mean? The amount of money that is going to be lost if you totally screw up your business plan is lower than if you go buy something huge. And it's like, oh, well, when you buy those other deals, they're non-recourse. They're non-recourse until you trigger something that makes it a recourse loan. And then it's just like the deal before, where you've got a recourse loan on a deal that has a property that you probably can't write a check to fix the problem. And this one, I'll stay on just a little bit because I think it's super important. There are going to be people in your deal who have capacity to write checks to fix problems. There are going to be problems. I don't care how good of an operator you are. And there are going to be times where you may have to write a check or go back to your partners and ask them to write a check. You really want to be careful about doing that because it will frustrate people. And while some will say, hey, you don't know what you're doing, there are things outside of your control. And I'll use COVID as a perfect example. You know, if you don't collect the rent, you don't have the money to pay the bills. And one of the most common things is, oh, well, this guy over leveraged his property. That's why he can't pay his bills. If you buy your property right, your debt service is going to be under 40% of what your gross potential rent is. And so I don't know if 40% means that you're over leveraged or not, but it's definitely not like a single family home where people are putting 90 and 100% leverage on it and then trying to figure out why it's not cash flowing. It's not cash flowing because you've got too much debt on it. We believe in altruistic investment, and this is a big part of the reason why joint ventures are so important to us, because we're able to be nimble in our deal. But James Bryant, who's one of my partners, he's a partner in just about every deal I do. He's got this thing about doing good while doing well. He was on the path, and I mean, he was on a tear to pay off his home. And he's like, when we started talking about this and the ability to make an impact in somebody's lives and the environment that they spend the most time, he's like, that actually makes sense. And he stopped that path so that he could have more cash available to buy more property. And so he's got this goal of positively impacting the lives of 500 people over the next 5 years. Well, it's less than that now, but that's what he was saying about a year ago. And I have this ambition of helping 100 people leave their jobs so that they can do the things that they're most passionate about through passive, or not really passive, but through income from ownership in apartment buildings. I believe that owners have responsibilities. I don't think it's all about just getting as much money out of the property. I think you need to make sure that you're investing in the property. One of my mentors, Pankaj Sharma, says you got to love on the property. If you love on the property will love on you. I think there's two types of properties that are out there. There's one that I call a goose. And so you feed the goose lays eggs. And as long as you feed the goose will lay eggs. And then there's alligator. You feed an alligator and the alligator gives you poop, right? And so you really want to have a bunch of geese in your portfolio and minimize the number of alligators you have. I won't go through all of these stories, although I think they're amazing stories. The one that I will use is on that 23 unit, the first deal we bought. We were so anxious to get the deal closed that we didn't notice that there was sewage backing up in the kitchen sinks. There was all the signs. There were stains on the cabinets. There was a building where a corner had sunk, but we didn't put two and two together until we got through the rehab. And it was like, hey, there's something wrong. And then we had to spend $30,000 or $40,000 pulling out the main drainage pipe and replacing it. What happened was the building sunk. It caused the pipe to crack, and the previous owner never fixed it, and we didn't spend the time necessary in order to do that. I just say that to say, hey guys, everybody makes mistakes, and the really, really, really important thing there is make sure that you're diligent in your due diligence. And you say, well, how could you miss that, Jerome? I didn't know. It was my first time through. I saw all the stuff, but I didn't connect all the dots. And that's why it's, from my perspective, so important to have somebody with experience, and not just pen experience, but actual experience as an operator, so that you don't miss stuff that ends up costing you serious dollars. And so here it is. Here's the screenshot, guys. The 10 reasons why we prefer joint ventures over syndication. 1, as a joint venture partner, you get to have input into what the business plan is. The pretty thing about syndications, if you're not in the GP, is you just get this offering memorandum or deal summary or whatever the sponsor wants to call it, and everything's figured out. It's got all the returns and it gives you an IRR. And I know what everybody does is just say, this one has this IRR, this one has that IRR. I'm going to go with the one with the bigger IRR, right? I want to be in the sausage making. And if you want to be active, then I think it's important that you get into the sausage making. You get experience, right? If you're in a joint venture and you own enough of the deal, you will get the opportunity to sign the loan. Or if you don't own enough of the deal and you just want to sign the loan, a lot of banks will do that because they like having more people that they can come after than less. You get to be more involved in operational decisions. You know, me and my guys, we do meetings. We have monthly reports and quarterly meetings, and we talk through what's happening at the property. We talk about next steps. We talk about what worked, what didn't work. And if there's a big ticket item, we have conversations about those as well. For me, and this is a personal mission, a lot of people don't care, but for me, like, I'm the son of a soldier and stay-at-home mom, right? So like, we weren't wealthy. We didn't have business owners coming over and hanging out and talking about their multi-million-dollar real estate investments at my home. And I want to open the door for more people so that they get access to this asset class, which a lot of people don't know that they can own. I think if you go to a city and there's, let's call it 20 200 unit complexes, there's probably 200 properties that are under 100 units in that same city. Probably a lot more, but just to give you an example of scale, right? And so when everybody's hunting for the same thing, I think it's super challenging to win. And I've heard stories of people having 30 offers, and then there's 10 people in best and final, and then it's down to interviews with 2 or 3. Like, I just don't know how you win. And by definition, right, if you actually get awarded the deal, you overpaid because you paid more than what anybody else was willing to pay. And that just doesn't sound fun. We like to be the only game in town, get the deal under LOI, evaluate it, make sure that the number makes sense that we made the offer on. And if it does, then we continue. If not, we get out. Again, less full-time competition, which I think is a competitive advantage. We like the opportunity, giving smaller operators the opportunity to retire. We think that, if somebody's done well, that they get they should have a great exit, right? They're selling their business. And I guess I haven't said that yet, and I really should. When you're buying an apartment building, you are buying a business. You're buying a business that has real estate attached to it, but the business is really what you're buying. And so that's why it's so important that you execute that business plan. People like to put these multifamilies in the same space as they would a stock or bond. Hey, buy it low, sell it high. Well, behind those stocks and bonds, or particularly the stocks, there's a business that's operating, and that business has to make money. Well, when you're a real estate investor, particularly a multifamily investor, that business has to make money in order for the stock price, air quotes, to go up. And you're not just going to buy the property low and sell it high unless you're in a market that's having some pretty dramatic cap rate compression. Again, there's less risk if it goes terribly wrong. That part is important because I think risk mitigation is something that when you're new to it or early in it, you kind of forget. You just want to go big, get as much as you can, grow, and you don't realize that preservation of capital is the most important thing that you can do. By being in joint ventures, I think it really expands work of operators because you're able to touch people in different markets, and there's a ton of camaraderie with this piece of the business. I'm sure there is with limited partners, but when you're actually an operator, you look over and you kind of give the man nod, right? And you say, oh man, you're a gladiator too. You're out here fighting. And I truly understand your struggle. And the last one, there's more back-end buyers, right? When you start getting into, and like, I got a ton of respect for Dan Hanford, right? Like when you're doing $50 million deals, there's but so many groups or people that can do deals that big. And so when you get ready to exit, it's going to a handful of people, where with the smaller deals, you get the opportunity to have a little more competition and have more exit plans is probably the best way I can say it. And so, oh man, I wish Spencer was on here. The ultimate question, right? Like, would you rather be on a fighter jet or would you rather be on an Airbus, right? Spencer was picking at me. He's like, hey, which is better, a hammer or a saw? And I was like, no, which one's better, a fighter jet or Airbus? It just depends on what you want. At the end of the day, I don't think anyone is better, but I think I really do have this contrarian view on not doing the syndication thing, especially for the people who are looking to be business owners, want to grow wealth, and don't just have this idea of, I just want to be a passive investor. We do 3 things, right? So we've got a real estate education company. We actually do operate a portfolio, and I do some coaching. And then we've got 2 live events. We've got the Mid-Atlantic Multifamily Investing Conference. That's happening March 19th through 21st of 2021. Early bird tickets are available. And we've got a mastermind for dads, because I'm a dad's dad, and I really don't think there is enough emphasis placed on being a great dad and committed partner and building a business. Is usually all slanted towards building a business. And so we wanted to take a spin on that and give people a cohort, a group, a pack that they could be a part of that embodies those values. And I promise free resources. And so here they are. If you want to jump over to myersmethods.com, you can get our free 4-step guide. It talks more about joint ventures and syndication and our approach to multifamily investing. And it also talks about the things that you can bring to a deal. I think there's like 3 or 4 different things that you bring to a deal. And one of them is the actual deal, but there's a number of other ones. And then the 2 podcasts that I think are applicable to this group. One is Multifamily Missteps. We get war stories from operators. And the other is the Dreamcatchers podcast, where we tell the story of people who have escaped the matrix. And what does that mean? It's more whatever you define it as. A lot of people want to do something different than what they're doing. And I just want to share those stories so that people can actually get inspired and then pull out the tools and tactics and techniques that people have used in order to make that transition. And so I see the chat moving. I am super curious about what's in here. So fire away.
Yeah, we'll get to it. I think there were a bunch of questions in there throughout the presentation, and just wanted to say thank you very much, Jerome. This is great, very eye-opening, as always, thought-provoking, controversial, controversial, contrarian, as you like to put it, but because you're raising points that a lot of people don't talk about, and I think it's really important. So I really appreciate you coming on and sharing this point of view and really kind of driving home what drives you. And really, that's the most important. And I think a lot of people relate to that. And the fact that we have almost 100 people on this call today just shows you that there are a lot of people interested in this and want to hear different points of view. So kudos to everyone for joining. I really appreciate that. And let's get to some of these questions. I think there were some questions. You have to scroll a lot up. And if you do have more questions now, but there were definitely a bunch in the above. And so we'll get to as many questions as we can, and then we'll break into the breakout rooms, obviously, because that's really fun too. Someone said, let's see if I can scroll all the way through. You probably beat me to it already, but
I'm not going through it. I'm counting on you.
Okay, so I'm doing it. So we got a bunch of 5s, a bunch of 4s, 3s. No, I'm just kidding. So great question. Really right at the beginning is, and really I'll stop with my question maybe, because I didn't even type it in there. But Ryan Beatty asked a bunch of questions, but I think they were kind of contextual to the presentation. So I'm not sure, some of them weren't like, why do you think that is, right? Like, but I don't remember at what point you said that. But the question that I had, so Ryan, if you want to go ahead and type in any other questions there or unmute yourself, that'd be great. The question I have for you is that a lot of people don't, that are thinking about getting into real estate, they did like what you did, right? They started listening to podcasts and maybe started with some small stick and flips, things like that. And then hear these ideas of like these programs. And I think they're really great because they're coaching. And like you said, the biggest waste of your time, your biggest, was the fact that you spent so much time without that proper guidance. So, there's always this kind of, dichotomy of like, well, yeah, this is catch-22. Yeah, I need that guidance to really get to the next level. But, and doing it on my own is not going to get me there. But then a lot of the guidance people that are out there are just pushing this kind of program. What do you say to that? Just take your program. That's because you're different. No, an objective answer.
And so I don't want anybody to pay money for something that they don't need to pay money for, right? Because in the end, the only reason a program is successful is the students actually get deals done, right? And so, that's why, like, if we haven't had a one-on-one conversation, you can't even find the link to take our online course. And if we haven't had a one-on-one conversation where I've interviewed you a few times or have really gotten to know you, I won't even take you on as a coaching client, right? So for me, there are people who just let it be out there and anybody can buy it. And maybe you shouldn't restrict the education from people because they may figure it out. What I will say though is I personally don't believe that it should cost a used Mercedes or BMW for somebody to find out whether or not they want to be in this space. And I always go back to, get some tuna in the boat, right? Everybody wants to go out there and chase Moby Dick and get this huge deal, and then they're set for life. And that's not real. That's get rich quick. What I want you to do is go do a deal that's $500,000 or 1.5 with your friends and family and somebody who else that you know is an experienced operator, and see if you actually like owning the deal, right? There is a lot of stuff that comes up that nobody really wants to talk about that is part of being in the business. And sure, yeah, property management deals with a lot of it, but like what happens when 20% of your people move out during COVID or can't pay, and you got to pay all the expenses, and there's still a mortgage to pay too? Does anybody get excited about writing a check to do that? I don't think anybody does. And so I think you need those experiences so that you know what you're actually getting into before you make an investment of that number. The flip side of that, Yonah, is you can go do it on your own and lose a whole lot more money doing it on your own because you take poor financing, you miss something in due diligence, like I mentioned, or some of this other stuff. I really see the education and the coaching as insurance for the person that's doing the deal. And for me, when I'm working with somebody, it's really about how do you do this well, not telling a person, no, don't do it. Because I'm going to say, hey, that's not a good deal. There's a reason why that's not been bought yet, or don't buy it at that price. A perfect example, I had a deal that I was chasing here, and somebody came in and paid 25% more than what I was willing to pay. I worry about that deal on the backside because I actually know what rents are here. I know what it takes to operate. I know what a renovation budget looks like in order to get it to the place it needs to be. But if you just go do it and you don't have that experience to fall back on, you can end up in a place where you spend too much and you can't get back out, right? So you do a $2 million deal and you get in trouble on that deal, the $50,000 wouldn't matter if you lose 200,000. And I think that's the part for me is I think about it like driver's ed. You want to make sure that the person doesn't run into a bridge abutment or run off the road. You want to keep them in the lane so that they don't get in trouble.
Gotcha. Okay, makes a lot of sense. Next question, and I think you spoke to the point of people ask, and I think that's really the point. It's not about the program; it is really about the willpower. Like I know a lot of people who have done, and I deal with hundreds of investors across the country. I see a lot of people going through these programs, and there are a lot of people that are successful that go through it. But I think you're right to the fact that there's a percentage of people that they're just not taking the action, not willing to put in the work, not really sure why they're doing it in the first place. So that's probably why they don't get into their own deals. But again, I think it really comes back to, the person's own drive. I do want to get to some of these questions. So Heath, Dr. Heath asked the question, did you have any deals before you exited the matrix? So while you were still working?
No, I did not. No, I was just doing fix and flip hard money loans.
Gotcha. And what, I guess the follow-up question was, I just X'd out the chat for some reason, but was what should people have in place before quitting their job? And I guess that's a tough question. But what do you have to say about that?
Yeah, if they go to Myers Methods, or not Myers, dreamshouldbereal.com, we've got a 15-point checklist for people, what things that we found people should have in place before they exit the matrix. And so it's everything from money in the bank to access to credit lines. Like we run down through 15 things.
Why are you so frustrated and going out?
That's right. I'm on top of muting. Go ahead.
I said, so dreamshouldbereal.com, and I'll put it in the chat, right? But this goes with the right down the line of dream catchers. But if you go there, we've got a 15-point checklist, and it goes through everything from the conversations that you need to have with people that are going to be impacted, how much money you should have in the bank, access to credit lines, a bunch of different stuff. And for me, that is like super, super important, because if you go out and you're not prepared, then what you end up doing is going right back in. And I call it like running back out the desert. It's not fun when you're starting from scratch. And one of the other things is just figuring out how you're going to make revenue. If you don't know how you're going to make money, or you've never had to sell before, and now you're going out and you have a business, if you don't have any revenue coming in, you're going to be in trouble when you're trying to replace that income that's going to take care of your bills. And if you're not living off a budget and you're trying to leave, you're in trouble already. You've got to run your personal finances the same way you would run your business finances.
100%. So I think someone asked me privately, but I think it's a more relevant question. Yeah, maybe not. Let me get to some of the questions first. So, okay, Jefferson asked me a question. For a JV deal that is remote to the market. So you talk a lot about being the one in your market, right? And just being investing in your backyard. And I think that's, for what you're doing is the best way to go about doing it. But he asked about what about when you're investing out of state, you're investing outside of your market. What do you think is a good responsibility that a partner can do, knowing they're remote in that area, and how to be safe that you're partnering with the right local JV partner? Okay, so there's two questions really.
Yeah, so from a partner standpoint, I will say, guys, don't diminish this. You're getting married, and you may have a prenup, but you're getting married. And so make sure that you actually understand who the person is. The things that we look for are people not to partner with. Everybody's always wrong. They're always right. Don't want to work with them. They are desperate to make money and they're just trying to figure out how to make fee. Our values just aren't aligned there. And I think the other thing is, like, they don't actually see the people that live in the property as people. Like, they've just lost the humanity and they just see them as somebody to send them money. Now, the other piece of that, Jefferson, there's nothing that I do by living in Greensboro that I couldn't do from Richmond or anywhere else. I just like the thought. It's part of my identity, right? I like the thought of being the asset manager in market. And the only real advantage that I have is, let's say something major happens. Say there's a fire, say a water main breaks, say there's something super expensive, and I want to go put my own eyes on it. A good example is a tree fell, right? We had a tree fall out of our yard onto somebody else's duplex. And it's like, okay, well, let me go check on it and see what's going on. And it's like, oh yeah, this is no worries. We don't need to do anything about it. Property manager gives you the updates, but at the end of the day, it just felt good to be able to run over and check that out and know that it wasn't going to be our insurance claim. It was somebody else's issue to deal with. But there's nothing that I do that somebody like my partners in Richmond, Virginia can't do. All the reporting's virtual. All of our meetings are virtual. Like, there isn't really anything that keeps us outside of being able to go tour a property, and the speed to be able to do that, or the level of convenience associated with that, is higher just because I'm 20 or 30 minutes away.
Awesome. A couple more questions here. Couple more questions. Let's see. There was one up above, but I think I missed that. It's all good. We'll just move down. Anyone can reach out to Jerome afterwards, definitely on LinkedIn or anywhere else through his website. Maybe put in there. Good question from Jim Morales. Jim from representing 10X, right?
Cardone.
Jim works for Cardone Capital, Grant Cardone. So I'm glad you're joining us here, Jim. Jim asked a great question. How are there any networking groups? Because you talked a lot about diversity at the beginning, and obviously are there groups that you know of for people of color that in the real estate space?
Yeah, Clive Davis has an amazing group called, I think it's called African American. Clive, are you still here? Clive is on here. He's got a great group on Facebook. Tiffany Ward started a group, and I think it's called MORE, and it's minority. I forget what the acronym stands for. That's on Facebook too. Outside of that, I haven't really seen any. What I will say is that, our Mid-Atlantic Multifamily Investing Conference has more minority speaking than they do majority, and that's intentional. I mean, the goal is to give people more exposure to others who are doing the business, but maybe aren't on a national speaking tour or have their own platform. So the goal is to give more exposure in that regard. And I just think they have fresh messages. It's not like super canned and they've given it 20 times and they just kind of zone out and don't listen to what anybody is saying or asking, because I've seen enough of that and it's very frustrating.
Well,
Thanks.
the only way you get really good at speaking is by speaking dozens of times. You have
Oh,
to.
yeah. I don't think you should repeat yourself, and I do think you need to be attentive to the audience. I agree with you, though.
Yeah, no, I agree with you as well. So another good question, Steve asked, how are you connecting with those who aren't in real estate, such as doctors, dentists, high net worth individuals? And do you allow those people who may have little real estate sense to be a GP or only passive? Or will you be paying a paying customer to jumbo jet? So I think he's combining different things, right? He's, I think, talking about what a regular syndication might look like. But go ahead and field that.
So the people who come into my deal is not because of their profession, right? It's because of the relationship that we've cultivated and having aligned values. For me, it's about getting to a place where we rig success by having aligned values and a shared mission. Will I partner with people who have little experience or don't really understand it? No, because them putting their money in the deal isn't that value for me. I'm looking for thought partners. And so what's exciting for me is like we built the thing, right? So you can go through our program so that you know how that we think about the world. It'll curate the content so you can go do your own thing. But if you want to stay and partner with us on deals, you're doing it the way that we do it. And so it allows you to get access to our network and get things done quicker from my perspective.
Awesome. I think last question. Yeah, Clive, thanks for putting that in on the Facebook, in the chat there, if anyone wants to check out the African American Multifamily Investor Network Group. How do you know how much is the max you should spend on a deal?
High is, the easiest way to answer this question is the majority of lenders are going to look for the combined net worth of the group that's buying the deal to be equal to the loan amount. And post-close liquidity of 10%, or yeah, post-close liquidity of 10%. What does that mean? We want, say you're buying $1 million deal or you're getting $1 million loan. They want the people who are in the deal to have $1 million in net worth, everybody who's signing for the loan, and $100,000 in the bank after you close the transaction. And that goes up. If you're doing a $10 million loan, they want $10 million and $1 million in cash. And so that's why this part is like super important. And you're like, well, I've only got $50,000. Well, then you need to partner with people who have more capacity so that you can do bigger deals. Or you do the deal that you can do, execute that business plan, get out of that deal and roll that money into the new bigger deal, because I think that's really is the game.
And it is a long-term strategy. I think, I mean, you've said this, and I think a lot of people say this, but most people getting into real estate don't realize that real estate is a long-term game, right? It's not a get-rich-quick investment strategy at all. And in fact, I'd say quite the contrary. The real wealth comes after spending a lot of time, many years, at it consistently. So that's that's what I would say. All right, well, Sterling, thanks for joining us right on time for. I'm just kidding. I know it's Eastern time, guys. We meet every Wednesday Eastern time. We are next week have a really awesome panel discussion of commercial real estate attorneys. So get your questions ready for commercial real estate attorneys who are going to be you're basically answering any questions that we field them. So I'm going to be trying or attempting to moderate that. Again, with attorneys, not necessarily an easy thing to do, but they're all good people. So I think it'll be fun. And they're all four of those attorneys that are going to be on the panel are participating in our 10-day challenge on LinkedIn. So that's cool. It's kind of a in-house kind of thing going on. So I appreciate you guys doing this, joining us once again. Again, we meet every Wednesday, 7 p.m. Eastern time. We got a great plan coming up the next thing. Yeah, Ron, next week will be a real estate attorney panel. So we're basically going to ask them any questions that have to do with commercial real estate. transactions. They're all transactional attorneys. A couple of them do litigation as well, but I think more from the transactional side. So thank you for joining. Congratulations, Jerome, for having the best turnout we've had yet in the 16 weeks we've been doing the thing. Your podcast, on Weiss Advice is still not the highest, but I guess if everyone on this call goes and listens to the podcast, Weiss Advice, then we'll get you over the top. That's for sure.
Get back.
What
Are
are
we
you
going? We need to do the selfie.
Yeah, we got to do the selfie. In fact, we got to do like 5 selfies here because Zoom only allows us to have like 20 people on the screen at once, or 25 people. So turn all your cameras on, guys, because we're all going to smile and say cheese on the count of 3. And we're going to do it, I think, like 3 times because, like I said, there's a bunch of different people here. So if you're still on here and you want to smile to the camera, say cheese. What are you pointing at, Joe?
You on my camera.
Oh, because on me, you're down here. Mine, so. All right, 1, 2, 3, give a smile. There we go. Beautiful. You guys are awesome. Thank you so much for joining. This has been a lot of fun. We're going to do it one more time because we love to get everyone in the multiple screenshots, even though I usually only post one of them to LinkedIn or whatever. So I'll choose the nicest one, probably the one with Jerome in it. Sorry, guys. But you guys feel free to share this with social media. Tell people about this awesome meetup. They can come and catch the Facebook live recording. So we'll get to the next one more time for those people on the second page. Give a nice big smile. Okay, you guys are awesome. Beautiful. So again, we're going to break out into the breakout rooms. If you guys don't know what that is, the breakout rooms are basically going to push a button, which is going to split everyone in this big call, about 80 people that are still here, into little groups of 4 or 5, and we just get to know each other and talk, amongst ourselves and start that process of networking the only way we know how in this COVID situation. So a lot of familiar faces. I'm really appreciative to all you that are coming out here tonight. Guys, next week as well. The first breakout room, we'll try to do about 15, 20 minutes. And then if anyone wants to stay on, we'll do a second one. If you're on the Facebook Live still, which I'm ending right now, click the link to get into the Zoom room before you can no longer do so.